Good afternoon. Markets are up. It's a Monday. I'm associate member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA. All trades placed by me are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. My position disclosure is roughly the same, except I had some covered calls expire in my favor, and I kept some Rivian. Overnight. Per Josh's call out. Thank you, Josh, for making me a few bucks today. All right, let's jump in. So we had a little bit of a bounce today. Who would have thought? Felt like forever since this market was green. 0.8% up for the SPYs, 0.9% for the Qs, 1% for the Russell. So nothing massive. Was a decent bounce. We did close off highs though. So a little bit of a tricky open. So we had the gap up this morning, and then the biggest thing that we we were looking for, that we discussed in the morning meeting, it was the same situation again this morning. So let's take a step back. We on Friday, same situation, maybe slightly different. On Friday, we hit extreme oversold territory for the first time, based on the way that I measure it, for the SPYs and the Qs. The SPYs got to about $10 worth of extension, and the Qs got actually much more than that. Looking at the Qs here, looks like the Qs are almost $15 extended at lows. But we also, and we were discussing this Friday in real time, talking about how difficult it was to buy the market on Friday, just because, well, coming into Friday, there was a big geopolitical scare on Thursday night that had futures down really big. And as we have discussed here the last few weeks now, and it's been really accurate, and we saw this back with the Ukraine-Russia situation, so we're just, learning from recent market history here. Market participants don't like to take risk into the weekend when there are dramatic geopolitical concerns. So it really wasn't surprising to see the market sell as hard as it did on Friday. The hard part for me anyway on Friday was like it was hitting points where we were getting really extremely sold with the Qs, and then the SPYs hit that point where it's like, man, I really want to start building into the long side. But I got the same problem as the market does, which is, do I really want to start building to the long side as the market finally becomes extremely extended to the downside, but it's Friday afternoon after a weekend when who the heck actually knows what could happen over the weekend? And the answer was kind of no, not really. I definitely did do some buying down there in the hole on Friday, but it was primarily just position management with the positions that I was already in, kind of getting heavier in them per my game plan as we scale lower and get extended. But I was a little bit afraid to put on any new real risk for the same reason as the market was selling, I guess, on Friday. So then, of course, this morning we get the gap up, and the gap up was large enough that it put us in a somewhat similar situation as we had been in on a couple other points last week. There were a couple other points last week where maybe we never hit the extreme oversold territory intraday at any other point in this broader market sell-off until Friday. But we've had situations where it's like the market was almost getting there, and it's like, if we could just get a gap down tomorrow, we'll be at that point. Maybe we can come in and start doing some buying, and then we would just gap up the next morning. And with the gift of hindsight, we know that every one of those gap ups got sold. But it was a situation every morning where it was like, oh, this is difficult because we're, let's say, $5 extended from the 80 EMA on the daily and the SPYs, which just sets you up big picture with like a bad risk reward, because that the market has the capacity to easily sell down at least $5 more to get more extremely oversold. And as with the case with the Qs, we know that it can be even more than that. The Qs got $15 away from the 80 EMA on Friday. So I don't really want to take a big picture stand here and start buying into a gap up in a weak market where I don't have extreme extension. But at the same time, from a shorting perspective, those shorts into those gap ups, even though they worked, were difficult because we know, similar to what happened today, that the market could rip another $5 to the upside if it wants to and get back to equilibrium, get back to that 8 EMA, or get to the space between the 8 and 21 EMA. So we kind of had a little bit of a similar situation here this morning. And Pat, I don't know if you're listening and if you kept anything over the weekend, but I remember you saying Friday into the close exactly what I was thinking, which is, man, I would kind of love to just take a stab here and take some, which usually is not the way I like to trade, but take a stab here and just buy some stock into the close and keep it over the weekend, because we'll probably get a gap up, unless, of course, the Iran-Israel situation escalates further, which absolutely could have happened, in which case then, also remember when we looked back at the example of when Russia actually invaded Ukraine and what it did to the market. That was, I think, the most extremely oversold away from the ADMA I've almost ever seen the SPYs in my entire career. I don't remember what the number was. I don't really feel like going back and figuring it out. I feel like it was like $20 or $28 or something like that, extended away from the ADMA, which would be the risk that you were taking if you bought some stock into the close on Friday, saying, hey, Qs are $15. It was 18 to 22 or so, something like that. Yeah, sounds right. Somewhere in that $20 area is what I was thinking too. But the point is, hey, the Qs are $15 extended to the downside. I'd love to take a stab here because we'll probably gap up tomorrow for a number of reasons. Tomorrow meaning Monday, meaning today. But if something really bad were to happen over the weekend, you could get the gap down that has the market $20 extended, and in which case you're, for lack of a better term, screwed. So made it difficult. And then we get the gap up again this morning, which puts us in kind of, at least with the SPYs, that same situation of, well, do I chase this gap up here this morning? We're gapped up to, I guess, what was the opening price today? Almost 498. Friday's low is below 494. So if you were just going to go long off the open versus Friday's low, you're taking $4 of risk there. $4 of risk for what? A snapback to the ADMA, which is $5 higher in a weak market. That's not really a good risk reward. But it's the same deal. Especially today, I felt that there was a higher probability that this market could rally, because the other factor that was a little bit different on today's trading session compared to some of the other gap ups we saw last week that got sold was that this gap up today could lead to some re-risking because of the degree of re-risking we had on Friday off of that fear trade, fear of escalation. And now here we are on Monday when there was no escalation. There could be a re-risking that really enables the market to get back to the ADMA on the daily chart. On top of that, I think Bill provided some really good market dynamic information to us pre-market about how if the VIX can kind of continue lower, volatility gets crushed a little bit, that it could lead to like a Vanna-induced rally on the upside for the market. So I think that we saw a bit of both of that happening at the same time, right? So nothing happened over the weekend. The market gapped up this morning. Granted, I do think that the opening price action, we can look at the small time frame in a second, was a little bit tricky. But at the end of the day, one of the big clues that we could get this rally was the fact that they just continued to kind of sell down the VIX. So the VIXy never broke its opening high. It was very weak all day. Or we can look at the VIX chart itself. VIX not only lost 18, which I think has some significance, it even lost $17 today. So this VIX coming down helped to also create the rally that we actually saw occur throughout today's trading session. So at the end of the day, it was an okay day. The market did basically get back to the ADMA on the daily chart for the SPYs. It did get back to the ADMA on the daily chart for the IWM, which I think showed some relative strength on Friday and some relative strength throughout the day today. And the Qs just being the most oversold on Friday actually just gave an inside day today and still have a good distance away from the ADMA on the daily chart. So the Qs will pay attention to the inside day to see if they can get an inside and up. SPYs in the IWM at this point technically gave you all that you could ask for. It is also notable that we are still in an environment right now where the data shows that we are going to see CTA selling this week, pretty much regardless of what the market does. They're selling in an up tape, selling in a flat tape, selling in a down tape, though there is less selling in an up tape than there is in a flat tape or in a down tape. It's also notable though that a lot of that CTA selling flow is front loaded, the number that we saw to the earlier portion of the week, which does mean, for the moment at least, that these bigger picture rallies will run into a degree of selling. So what we discussed kind of in the morning meeting today, which I think was really the right idea, is what has the potential to overwhelm the market and create the market movement more today. Is it re-risking coming back into the market today because nothing happened over the weekend, especially if the VIX declines? That's obviously buying. Versus CTA flow selling, which is systematic and we know is going to be selling no matter what. What's going to overwhelm the market more? And what we saw obviously was a battle a little bit between both buyers and sellers. I think to some degree made the smaller time frame price action a little bit tricky. Again, I could talk about that in a second. But overall, one in which the buyers were able to win on the day, but it wasn't such a dramatic rally that it changed the picture of our daily chart. We still have a bearish looking daily chart, small time frame daily chart, and if anything, like I've been saying, my biggest complaint about last week was that I couldn't get a big enough of a rally to a spot where I would feel very confident to apply some further shorts, but I also couldn't get a heavy enough of a sell-off until Friday afternoon to get us to a point where we were sold enough to be able to come in and buy. The rally here today, if you were aggressive, you could have started shorting a little bit into the EDMA in the daily chart. For me, when we hit highs of the day, I was running around the post office, which I ended up having to do twice, and I kind of had my finger off the pulse there for a minute, which is unfortunate because I think I probably would have wanted to reinitiate some of those covered calls I have at that high, but I didn't have the opportunity to do it. But it potentially gives us an opportunity to be able to have more of a tradable setup than I think that we actually had the last several trading sessions, when it was more or less just like orderly downtrend flow selling feedback cycle of selling leading to more selling last week. So I would say that today was productive for the bulls, but by no means gets them off the chopping block. And potentially for us as traders, today was a good day because it set us up a little bit. And on the small time frame, it was tricky because of the gap up, but I do think that there were some okay tradable opportunities. The biggest thing I wanted to see in the morning, because we were gapping up so big, I was just like, patience. Let's see if the setup comes in, and let's see what we look like after the first 15-30 minutes if we consolidate and the ADMA catches up, and then we can potentially get a signal. Now we talked about one of two things pre-market this morning. Either we get that consolidation breaks up, or we get that consolidation breaks down, and then you could trade in the direction of the actual break. And what that would look like, and I think that we were able to recognize this by 10 a.m., would be a real clearing above 498 for the SPYs, where maybe you could get a move. I was saying initially to 500, the ADMA on the daily being closer to 502, 503, which that never happened. Or do we get like a small time frame negative Maribosi breakdown candle, which is really what we got at 1020. So what I was saying, and these candles are so important, I think, when they actually come in, especially when you no longer have extension in the market. I always really try to note them. Really, this one was very important, and this one here at 1050 was really important. They're just really important because, again, I call this candle like a penalty box candle. This candle broke the market lower. This candle, once it finally cleared, told you, at least on a very small time frame, you're actually better off being short than long. But it also gives you a really good reference point, because you know that if the market can ever actually negate that, then that flips. And then, once again, you become better off being long than short. So when we start to break down here, if you're just looking at the spies, you could say to yourself, like, okay, spies breaking lows, this negative Maribozu came in after this consolidation. We're breaking all that to the downside. The small time, the big picture we know is still kind of in no man's land from risk reward perspective, but on the small time frame, I can take some trades here to the short side. Now, what do I want to do if I see an opportunity on a 5-minute chart like this, where maybe I can start to look for shorts or whatever, or the opposite, forgetting about 498, I can look for longs. What do I want to do if I see those types of opportunities coming in on a small time frame, but the big time frame, for example, like today, tells me that I'm in no man's land and that, we could rip up to 503 or we could rip down to 493, and it's almost same flip a coin from here. It tells me that the small time frame trades that I actually do want to take, first of all, pay attention to relative strength and relative weakness, but also probably don't take them with a massive amount of size. So that was kind of the big focus. And I didn't love the short idea on these because I don't want to just be looking at the spies in a vacuum. I want to be looking at the other indexes at the same time. And again, I want to be looking at relative strength and relative weakness. And I felt that the IWM was actually still so strong at that point of the day that even though the spies, and we can take a look at the Qs also, were giving us some short time frame like sell signals here where maybe you can push to the downside, maybe you can short this little upside tail or whatever. I don't have confirmation at all from this Russell, which I thought looked great for almost all the day. Maybe a little bit of a concern that this pullback between 1040 and 1125 was a little bit deeper than it should have been, but it never really broke any major levels. It never broke the opening low or anything like that. There was a lot of overall relative strength here where the Russell was almost telling me more worst case scenario isn't a heavy sell-off today. Worst case scenario is sideways price action. Best case scenario is that this IWM continues and eventually these spies and Qs start to turn around a little bit also, which is actually what occurred. So, again, I guess the lesson here that I'm trying to get across is more understanding layers of probability, specifically the layer of probability of time frame continuity, where is your small time frame matching your big time frame? Is it overall telling you that you should be more aggressive or less aggressive, and taking it from there. So yeah, that kind of I think summarizes the market. I mean, from an individual trade perspective, like I said, I was being cautious this morning. I liked the Rivian call out that came out from Josh, which I believe was on like the second candle of the day here when it was rallying back. It definitely needed to break that opening high. It seemed like they were hitting this thing down because they were hitting all the electric car companies this morning, and Tesla was very oversold with this Rivian, which I don't love the company Rivian, but I'm also a believer, like we've discussed, that I don't think that they're going to go bankrupt because Jeff Bezos. So I thought that with the gap down this morning, if they could rally some of those long duration assets a little bit better, which is what I was looking for, and honestly that did not fully materialize, that this thing could go. So I kind of jumped into Josh's idea on Rivian. Really needed it to clear the opening high, though. Once it cleared that opening high, I started looking pretty good. It was an okay trade. And then the only other thing I really did was going along the IWM off the low, which I didn't love at that time because for the first 12 minutes of the day, the Russell was actually relatively weak. And then it actually regained strength and was strong compared to the other indexes. But this, gap fill into the moving averages as it creates a tail back up, I thought was a trade that was worth small risk. I thought that at a minimum I could get like a decent retracement of this candle, which is really all that I was looking for initially, and that potentially a little lower probability I could eventually get a break of this high that could give me bigger continuation, which is what I got. I did it via TNA. I kept it all day. I kept 25% of my position all day, and then I was very tempted to keep that overnight, and I just decided not to. I just still have like a bunch of long positions on that I've gotten heavier in the last couple trading sessions as we moved down. I don't feel like I need more long exposure right now when we still have some pretty broken big picture technicals that need to improve. But I did keep some of this Rivian. I'm not huge in it, but I want to see if this thing can break up and give me a move for a retest of like this $10 area. So probably have a target right now like $9.75 or so, just on an initial snapback, and we'll see what he can do. But yeah, so that pretty much covers my day. It covers the market. I think there's a couple lessons in there from the market as well that we can learn from. But it covers everything that I have. So I am happy to answer any questions that any of you guys may have. So first thing I'm seeing is from Jeff. Does CDNS spark a new round of tech selling? Oh, so we are in earnings season here. We got some big ones coming out later this week. I don't know this company CDNS very well. Are they related to the semiconductor names? It's had a pretty big rally also. Is it a semiconductor? I really don't know the stock. But we have certainly seen like the Taiwan semiconductors added to the sell-off for the overall market, because I think it added to the sell-off of tech, or ASML added to the sell-off of this overall market because their report added to the sell-off of the semiconductor names. So CDNS I don't know as a company as well, to be honest, as Taiwan Semiconductors or ASML. But yeah, if you got any other information on it, would obviously love to know. Just not seeing anything else in the VTF for the moment. Let's see what's going on. Do I got the echo going on? Is it still echoing? Noah Schultz on YouTube said I had an echo. I'm not sure if anyone else is seeing that or not still. The VTF's always good. It's weird. I did what I typically do to make sure that there is no echo. Still echo. Did that fix it? I think I know what I did that changed my settings. Yeah, I think I know what I did. I think I changed something. I got a weird volume setting on this computer for some reason that creates an echo in YouTube sometimes. But I should have just fixed it. Thanks, Robert. Sorry for not noticing your comment earlier, Noah and Joy. Joy asking me my views on Labu. Also, a couple posts under his name. So Labu, I'd rather look at XBI. So Labu is just the 2 or 3x leveraged, which they've reverse split apparently. XBI. This XBI is going to move with the IWM more than anything. So any view that you're taking on biotech, you need to have a view towards the IWM. XBI is going to benefit the most, and is probably one of the most interest rate sensitive sectors that's out there, meaning higher interest rates are going to be really bad for any speculative biotech. This was definitely due for a bounce, which we started to get on Friday, and similar to the IWM, it showed some relative strength on Friday. Some of that relative strength carried over a little bit today. It's tough to take a stand on this XBI after this not so great 2-day bounce, though. If the market wants to continue this, they could definitely get back up to that $86 to $88 area. But I don't think I would take a stand on XBI right now after this bounce has already occurred. I'd rather have that RDR set up where it's deep in the hole and I'm coming in and I'm buying some, and then if I've got a profit cushion on it, I can look for continuation. So I'd say if you already have a position in it, you can still look for that continuation, maybe $87, $88 and a really nice bounce. But if you don't have a position, I wouldn't be rushing into this after it's already given a time and price correction for like a trading session and a half or so here. It just looks tricky. So I hope that helps. And then you're also asking me about Goldman and ASML. Goldman looks great. Financials were great. Were great again today. Goldman looks like it actually was a leader of the financials today. I thought that the last earnings report from Goldman Sachs was the best of all of big bank earnings reports. This thing looks great above 410. I hope you're in it already because I don't like chasing day twos, I think, as you know. And tomorrow will be a day two. But Goldman looks fantastic. ASML, so there's a lot of inside days out there, which I think will be notable tomorrow morning when you're doing your research. The Qs had an inside day, therefore a lot of these names are going to have an inside days. ASML had an inside day as well. There's a lot of extension here in ASML post earnings report. There is room for this thing to bounce to 910, 920, 925. So if you get the inside and up tomorrow, it could potentially be tradable. But let the signal come to you if you're doing a counter trend. Try to buy on the way up. From Kevin G, any thoughts on tomorrow's PMI numbers? The forecast is 52. Are we thinking higher numbers are bad for the market? We saw the April 10th CPI rise 3.5%, and it had a strong sell. So I think that where we are with some of these economic numbers right now is that we kind of want them to be in line. I don't think growth is a bad thing for the market right now. So 52 obviously indicates growth. Anything above 50 indicates that there is growth. So an inline number or even like a slightly hot number I don't think would be a disaster. What you don't want to see is a really big. You don't want to see. I think that broadly where we are, almost regardless of the economic number that we're looking at, is that really big beats in either direction are going to be viewed badly for the market, like really big beats or really big misses. Whereas more inline-ish numbers that can represent a healthy amount of growth but aren't leading to a massive increase in inflation or inflation worries, are kind of Goldilocks. So I think like if we hit that 52 number, that's kind of a Goldilocks number. You've got economic growth, but it's not so extreme that it's going to overly reignite inflation. So that would be my thought process. A little bit of a beat I don't think would be the end of the world either, nor would probably a small miss. But a big beat or a big miss, you get a really big miss, you get a number below 50, then you have to worry about economic contraction, or at least the market will be. You get a really big beat, you get 54 as your number, then the market is going to be worried that the economy is running too hot, which is no good for inflation. So that would be my thought process, Kevin. One more question here in YouTube from Bloodknot. Would today being green be enough for a signal for starting some longs, or do we need more from the daily charts? We need more from the daily charts. For the moment, this is just an oversold bounce. The market hasn't confirmed anything. It hasn't broken above any key levels. There is no signal at this point that this is the extent of the sell-off and, we're going to get a V-bottom here. I mean, it could happen, but we just don't have a signal for that yet. So show me that the market can bounce right now to 506 in the SPYs, and then pull back to 502 and create a lower high, and then get back above 506, and then I'll say, yeah, we're looking like we're back on the bull market. So I think that we are still a ways away from being able to call this little oversold bounce where we barely touched the 80 MA for the first time, saying that this is it. This is it. Because we're not. The flip side of it also is, we could absolutely bottom here, and it would just be a healthy little multiple correction for the market, and we snap right back. But there's no technical signal that this is anything more than an oversold bounce yet, and there's also no real signal from our positioning or sentiment. If anything, all that's happened from positioning and sentiment is that it's pulled back a little bit from what was more extreme territory. There's no signals right now from a positioning sentiment perspective that were similar to what we were seeing at the end of October, which was really signaling for us to, come in and get after it to the long side of this market. So more time, more information I think is really required. We got Tesla earnings tomorrow. We'll see. Elon Musk needs to hire someone else to speak on those calls, because Elon's just been nothing but a disaster on every earnings call he's had, and who knows what he'll be trying to blame this down and move on. But yeah, we'll see what happens with Tesla tomorrow, and then we also got Meta, Alphabet, and one other, Microsoft, I forget, this week on Wednesday, Thursday. That's everything from YouTube over in the VTF from Eli. In your first 5 years, did you find yourself having a good sense of the market's profile but failing to execute properly, such as sizing up on an A-plus move and not giving it enough room to breathe? All right, sounds like a specific you question, which is fine. In my first 5 years, that's a really broad period of time. It's like a third of my career. I think I'll just speak a little more broadly, and we'll see if it kind of covers your question or not. So, the trading journey is really difficult because, especially as you're in those first few years, as you're starting out, you need to figure out what type of trader that you are. You need to figure out what types of trades work for you. You need to create a rules-based system for those types of trades that work for you, for who you are. And you always need to do it within the context of understanding the market environment that you're in, because the market environment is constantly changing, and that will also have a large effect on the strategies that you're implementing and the degree to which they work. And I know for myself, I feel like I had a bunch of early, almost like false starts in my career, where there were periods of time early on where I started to feel like I had it all figured out, and then the market would just kind of punch me in the face and say, "Nah, you don't have this all figured out yet. You still got a lot more to learn, sir." And that was always really difficult. And usually the way that works is, especially if you're a newer trader, let's say that you started trading a month ago. All you know is what the market looks like over the course of the last month. You only know this one cycle. You only know the market going up or the market going down, or the market with a low VIX or the market with a high VIX. You only know kind of this one market profile of this current environment that you're in, and that's all you really have to work with. And you at the same time are trying to figure out, well, what type of trader am I? Am I a patient trader? Am I more a trader that's going to be banging the keys a little bit more? What types of strategies are more suitable for my personality, strategies and time frames, and you're figuring it out, and you're working towards it based on the market environment that you're in, and then you start to develop some success. Because based in this uptrending low VIX environment, and that's not necessarily the environment we're in right now, I'm just trying to use that as an example. Based on this uptrending low VIX environment, you figured out that you can put XYZ trade on and be consistently profitable from it. You are consistently, buying dips on 15-minute charts as hammers come in, and then riding the trend throughout the trading session, and then closing the position into the close and not keeping it overnight. And this is working great for you once you figure it out. Your first month after you figure it out, it works great. You have a nice positive P&L on that month. And what do? Well, you do exactly what you should do, which is size up when you're seeing success. This, by the way, is always why I suggest for traders when they see success to size up slowly and not make massive sizing up situations, because again, sometimes the market will give you a kick in the seat of your pants if you get a little too big, you get a little ahead of yourself. But you size up, and then month 2, looking good. Same deal, same market environment, low VIX, uptrending, buying those 15-minute continuation hammers. So you size up a little bit more. You think further about your game plan. You start to think about, well, if I can make $500 a day in this environment with these numbers, I should 10x my size to make it $5,000 a day. And maybe you start eventually getting a little bit too big too fast, and then guess what happens? You've still only ever seen that one market environment. You got this one trade that works great for you, and all of a sudden something happens, and the VIX starts to spike, and the market trend starts to change. And maybe I'm describing you as a trader if you got started on February 1st or January 1st of this year, and you just caught this great uptrending environment, and you figure out strategies to take advantage of it, and now you're sizing up a little bit in February, and you're sizing up a little bit in March, and then you're sizing up a little bit in the beginning of April, and then holy crap, my buying the dip on a 15-minute chart is not working anymore. The VIX is up, we're breaking down, I don't know what's going on, I'm losing money every day. And if you sized up too fast, you probably, in a very short period of time, could lose all of the profits that you made in all of January, February, and March, which again, allow me to repeat. As you see success, size up slowly. And then that's what I describe as a false start. This happened to me a few times earlier in my career, in the first few years of my trading, where I finally, was making really good progress, and then something happened and caused a change. And now all of a sudden, if you've been implementing the exact same strategies last week in the biggest sell week since March of 23 as you were from January to the beginning of April, they're not working. They're not working. You're getting smoked. You got to figure it out. The biggest thing for me, and the thing that probably enabled me to survive the learning curve and continue in this business, was that I always did a relatively good job of managing risk. And risk management is the key to success in the business. It's one thing if you're going through your education cycle as a trader, and you're trying to figure out the market in different environments or whatever, and what strategies you can implement in different environments, and all of a sudden you find yourself in a period of time where you're not making money in the same way you are. That's fine. That's fine. I really think it's part of the learning process. It's something entirely where you say, into this down move, it's Tuesday or Wednesday of last week. Oh, screw this! I know my strategies work. I'm not stopping myself out. And then next thing you know, you blow up your entire career or blow up your entire account. So, risk management will always, always, always be the key to success in this business. I don't care what level of trader you're at. I don't care what level of experience you're at. Market environments are always changing. And so for me, I think one of the biggest things that kind of helped me to break a little bit of the cycle that I'm describing, one is just experience, to be totally honest. It's just doing it for long enough where you see different market environments. It's like, okay, I've dealt with a bear market in the past. I've dealt with a pullback in the past. I've dealt with a low VIX in the past. I've dealt with a high VIX in the past. I've dealt with all these different types of market environments. The experience level definitely helps, but on top of the experience level, and I think that this is like a huge level up as a trader when you can get to this point. It's probably one of the most important and most difficult things, is figuring out that the environment is going to change as it's changing or even before it changes, which is why we spend an increasing amount of time as a team here over the years talking more and more and more about not just technical analysis, but more and more about positioning and flow and sentiment. Because a lot of the environment change stuff is forecasted through an understanding of positioning and flow and sentiment. And that's why, to re-emphasize it, Pat's note is so important to read every day. It's so important to read. Even if you're a new trader and you're reading Pat's note, there's a good chance that you don't understand 80% of what you're reading, and that's fine. It's honestly part of the learning process. Sometimes I'm reading Pat's note and I don't understand what I'm reading, to be totally honest. Get out your Google, get out your Chat GPT, and you probably don't have time in the morning before the market's going to open, but there's nothing stopping anyone here after we get off this afternoon meeting to review and revisit Pat's note this morning, which, as I'm telling everybody how important it is to read, I didn't get to fully read it this morning. Between us girls, I wish Pat could get it out just a little bit earlier in the morning than he does, so that I would always have time to read it. But there's some phenomenal information in here. I love getting these updates on these like forward PE levels and implied PE levels based on an historical regression versus rates. I mean, this is really good stuff. And then the stuff that I was trying to point out in the morning meeting this morning, and honestly, the reason why I started the morning meeting like 3 or 4 minutes late this morning was because the information in Pat's note that I was trying to get through and I was just crunched on time is so important for my overall thought process to the market that I was like, sorry guys, you're gonna have to wait 3 or 4 more minutes because I really wanted to get through a few of these paragraphs in here. But this stuff in here is just so important to learn and figure out. And like I'm saying, if you're brand new to trading, you might read this page here, and this is a page I think everyone should really go through and not understand 80% of what you're reading. But Google it, figure it out, and honestly, just read it every day. Even if you read it every day and you don't understand what you're reading, you'll learn it better by reading it every day when you don't understand what you're reading. I really think that's true. So like these couple paragraphs here, they were talking about systematic supply and kind of where that stands at this moment, and that there's still 26 billion forecasted of equity supply next week into a flat tape. I'm pretty sure it's a global number, not an S&P number. I think the S&P number was like 15 billion or 18 billion, and you want to learn to understand that within the context of how much a market moves on a dollar basis in a given basis. But I wanted to point out that in combination with this, which kind of shows us a little bit where our positioning is after some of the selling that started to come in. With the gamma information here and that's effect on the market, where those are the main few things that I was trying to highlight out of Pat's note. And then short-term tactical was in the green again on Friday, which didn't matter that much because we gapped up this morning. So this is where I try to derive a lot of my big picture information that helps me to have an understanding of how, when, and why the market environment can change. But then I obviously need to do that with a backdrop of the technicals, because the technicals are actually telling me the supply and demand situation and the environment in this moment. And I think if you go just purely based on, if you base everything based on just 100% sentiment and positioning, you might have started to really try to short the market in a big way in mid-February. If you guys remember, I described myself as becoming increasingly less bullish starting back in mid-February. And that was after being a super bull at the beginning of October, beginning of November. We caught that up move. I started becoming increasingly bearish in here because the data was beginning to show me an area where, all right, we might be coming into a market environment change. But if we're coming into a market environment change, I also need the technicals kind of to confirm that. And the technicals are just showing that we were just in this straight up uptrend. And every time we tried to break lower on CPI, on PPI, we would just immediately snap back. So we take, we call them like technical days to take note of. We already know that the information is signaling as we're coming into the beginning of April that if there is a catalyst that increases the VIX, or if there is a catalyst that causes the market to break support levels, that we could very easily go into a feedback cycle of selling. We know that. But I still need the catalyst to come in. And that could be a fundamental catalyst. It could be a technical catalyst. It could be a combination of both. It's usually kind of what it is. And that signal, in a lot of ways, was this day here on April 4th, which I think I wouldn't be surprised if the afternoon meeting on April 4th is just as like a day to take note of or something like that. Because this was, I think, the first day that we started to get some of those geopolitical concerns. But we also had, it wasn't quite a push-through failure, but it was a big gap-up failure with this large negative Maribozu here on big volume that seemed to me in some ways technically similar, if anyone remembers it, to this July 27th day, which this was the last time in this top, I don't feel like I nailed this top perfectly here that we had at the end of March and beginning of April, because it started to become a little bit bearish in February, and the false starts on the downside that we recovered from had me like, wow, this market, with the very heavy positive gamma and everything, is doing such a great job holding in. This one we called like literally to the day. We hit the point where sentiment and positioning, similar to kind of where we just were here, was getting really stretched and indicating that we were kind of due for a pullback. And then we had our technical signal, which was this push through to new highs, complete failure, negative Maribozu, close on lows, never regain that high. And it's led to a very healthy 10% plus correction overall in the market over the course of 3 months. And we literally flipped on a dime from being bullish from the breakout that occurred at the end of May to basically going bearish on July 27th to literally going back to full bull mode at like full max bull mode at the very end of October for the exact opposite signaling. This was an area, and this actually goes back to somebody else's question, I think from the YouTube or somewhere else, this was an area where positioning and sentiment was starting to really give us the buy signals to come in. We knew that there was going to be a ton of forced buying in the course of the month of November. And that's what I'm saying when people are asking me, I think it was a YouTube question about, can we feel confident that, you know, today's balance means that it's the low of the market? I don't think that we can. You know, we could easily, especially if the VIX continues to come down, continue to snap up, and this could turn out to be a bottom, but it's not. We definitely don't have a signal like we had at the end of October, where positioning was washed, sentiment was washed, and on top of that, even as all that was washed, we knew a massive amount of forced buying was going to come into the market. This right now, in some ways, is the opposite. We find we've pulled back a little bit on kind of that max positioning and sentiment on the upside that we had at the end of March and beginning of April, but we're nowhere near getting any sort of positioning or sentiment trigger to the long side, and if anything, we know that a lot of systematic strategies are still forced sellers in this market, and we are in our, like, you know, corporate blackout window where we know that the buyback machine's not really on right now to create insulation from the market there. So yeah, you know, it could just be a real simple, healthy, normal little 5% correction that happens in the S&P. I think that happens every 4 months or so on average, something like that. And then that's it, and we snap right back up. Easily could be that way. But we don't have any real indication yet that we've bottomed or that we're going to turn around. So I know I'm starting to get a little bit off topic on your question there, Eli, but you know, the whole thing is absolutely a process as a trader. You know, you get these false starts in your trading. You learn from the things you do well and the things you do poorly if you're keeping good journals. And going back to your comment here on sizing up on A+ trades, giving things the right amount of room. And I know you said giving it enough room to breathe. I'm going to change your comment to the right amount of room. There's a balance. There's a balance between enough room to breathe to let your trade work properly, and, you know, and too much space. And you need to give something the right amount of technical room based on the trade setup as it actually comes in. But you know, I remember I remember the first time I successfully traded an A+ setup. I think I was 8 months into my career or something like that. It was in Visa, and I almost got stopped out of it by 2 cents. I had the most amount of size I had ever had on a position. Up until that point, I had seen A+ trades, but I had only ever seen them in hindsight, which I learned from because I kept really good, really strong journals. You know, where there'd be so many times where it would be only after the market closed that I'd be doing my research, and I would recognize, wow, everything really came together in this trade in such a way where this was a setup that I should have been way heavier in. I would see that after the fact. I don't think there's anything wrong with seeing things in hindsight, because you see things in hindsight enough, eventually it ingrains itself into your brain where you can kind of see it in real time. And that's finally what happened to me. You know, I was like, okay, here it is. And I took that trade and almost got stopped out by 2 cents, because even A+ trades can fail. But then that trade ended up working and became my biggest P&L, day to my career up until that point, I think. So I hope that kind of answers what you were looking for there, Eli, with your question. If it didn't, obviously let me know. I can try to get into more detail, or if you have any follow-up thoughts or comments or questions, obviously I'm happy to help with that also. Which earnings do I think is the most important this week from Carol? So it's Amazon, Alphabet, and I think the third one's Microsoft. Probably Microsoft's the most important of those, but Amazon and Alphabet would be really important also. Tesla I don't think matters that much. Thanks. Cool. I'm seeing some more questions or comments in the YouTube, so we can take a look at that real quick. What are you sending me 0.0025 Bitcoin for, Kevin? I don't even follow you. But I'll take it. I have no idea how much money that is. Well, it's nothing because you can't actually buy anything with Bitcoin. Oh, Pat's game plan. You gotta send Pat to 0.0025 Bitcoin for it. From Gabriel, what would you grade the gap fill long trade on the IWM, given that the IWM showed relative strength on Friday? Oh, that was the trade that I took. I didn't grade it that highly because I didn't take a ton of risk. I bought it real small. I didn't like the relative weakness that it was showing in the first 15 minutes, and I was concerned pre-market. Pre-market, I was looking for the IWM to be relatively strong, and I was looking for long duration stocks to be relatively strong. And then I took a big step back in my thought process. This is all before I even did the morning meeting today, because the TLT was gapping down. And the TLT was probably gapping down also as a little bit of a resolution of the fear trade because nothing happened over the weekend. But my concern was that interest rates being higher would just put a little bit of a damper on the IWM. So then coming in with that thought process, but all three indexes gapping up roughly the same, we had no real relative strength or relative weakness pre-market. I wanted to see what was relatively strong, relatively weak after the market opened. And even though throughout the entirety of the day, I would argue that the IWM was probably relatively strong, in the first 10 minutes, the IWM was very relatively weak. You can see the Qs held in their gap, and the IWM fully filled their gap in the first 12 minutes. So then I was like, that second part of my thought process about TLT being down and interest rates being up, leading to relative weakness in the IWM today, is turning out to be what's the case. And even though the Russell was relatively strong on Friday, we see these fits and starts from the IWM where it can be relatively strong for a day here, a day there. And big picture, obviously, what do we know is that big picture, the IWM has been relatively weak. So that made me very cautious on that trade, which I still took it. I liked it enough to take it, but I took it with relatively small size and relatively small risk. So if I was grading it, I probably would grade it like a B- or something like that, C plus in that zone. How long until you felt you were a CPT? Oh, a consistently profitable trader? Oh. It's a really hard question to answer. Because it kind of goes back a little bit to like the false starts what we were talking about with Eli. I felt I was a consistently profitable trader after like 3 months trading. I did very well when I first started. I had a strategy that worked great in that environment, and I was able to do pretty well as a new trader kind of early on. And then I think I was like 2 years in when I hit my first real, more major slump, and by that point I took a big P&L hit because I had sized up so much by that point, and then I kind of had to reinvent myself. So I don't know. It's honestly not a question I've ever asked myself. It's funny that you're asking me that because I don't think I've ever asked myself that, and it's funny that I've never asked myself that because it's really the true goal of every trader, right? Is to be a consistently profitable trader. But I don't think about it like that. I don't think about it like all of a sudden one day a switch flipped and I was a consistently profitable trader. I really look back on my trading career and very much think about it as an evolution. As an evolution of honestly who I am as a person, an evolution of market environments, an evolution of strategies, an evolution of trial and error, and that's led to various points in my career of more and less success. So, thanks, Kevin. All right, cool. So looks like I got through everything in YouTube and the virtual trading floor. I apologize for the echo in the beginning of the YouTube. I got to figure it out now. The thing that I normally do to fix the echo didn't work, but that was because I did a change to my settings. We should be good for future meetings going forward. So have a great night, everybody. See you tomorrow.